While everyone was distracted by the Supreme Court ruling, silver was quietly telling you who is really in control. The court ruled that President Donald Trump's emergency tariff mechanism was illegal. The headline hit. Algorithms reacted. Silver flushed hard to 79.80. Fear printed on the screen in real time. And then something happened that most people will not process correctly. Within the same session, silver was bought aggressively all the way back to 84. That is not a random bounce. That is not retail dip buying. That is demand stepping in with conviction. Gold closed the week at 5,100, the highest weekly close ever recorded in market history. Not an intraday spike, not a temporary squeeze. A weekly close. Sustained conviction after 5 full days of positioning. At the same time, the Comex vault drain did not pause. It continued, and UBS just published a silver deficit projection for 2026 that most people are going to underestimate by default. We are going to break all of this down carefully. But first, something important. There are always copies when something becomes worth copying. Someone to sell you a signal, a course, access to a private group. That part is obvious. The harder ones to spot are the ones who repeat the language, mimic the tone, borrow the structure. But when the market actually moves, they either go silent or explain it after the fact. Precision cannot be copied. Last video, I did not give you 10 scenarios. I did not draw wide zones. I gave you one level, the 3 a.m. New York hourly candle. Not 2 o'clock, not 4 o'clock, that exact candle. Why? Because it reclaimed the prior high. Its low became the invalidation level. As long as price held above that candle, the structure remained intact. Today at 10 a.m., New York time, what did price bounce from? That same 3 a.m. candle. Exactly there. That is not luck. That is tape reading with precision. Now zoom out. Let's talk about what silver is communicating structurally. Comex registered silver, meaning metal that is warrant issued and actually available for delivery, currently sits near 88 million ounces. Over the past 30 days, total Comex silver inventory has dropped roughly 51.9 million ounces. That is a 12.4% drain in 1 month. In a single recent session, another 1.4 million ounces were pulled across multiple custodians simultaneously. The coverage ratio, registered silver versus open interest, is approximately 0.14. Translated into plain English, for every futures contract theoretically capable of demanding physical delivery, only a fraction of the required metal exists in a registered category to satisfy it. These reports are public. Anyone can verify them. Now let's connect this to the Supreme Court ruling. The court struck down the emergency tariff mechanism used to impose rapid, broad tariffs. That potentially exposes the government to tariff refund liabilities estimated as high as $150 billion. If large refunds are legally required, that creates a revenue shortfall. Revenue shortfalls mean more borrowing. More borrowing pressures Treasury yields at a time when debt trajectories are already stressed. On the other hand, removing broad tariffs theoretically reduces some inflationary pressure over time. Two opposing macro forces are now active simultaneously. President Donald Trump has already stated that alternative legal mechanisms will be used. Section 232 National Security Authority remains intact. Section 301 Trade Authorities remain intact. The speed and pathway may change. The policy direction does not. In prolonged trade policy uncertainty, regardless of which legal channel it flows through, keeps capital searching for assets outside that disruption radius. Silver's response to the ruling was unambiguous. A flush to 79.80 on genuine negative news. An aggressive recovery to 84 within hours. When a market absorbs bad news and reverses violently higher, it is telling you something about the strength of underlying demand. Now, let's escalate the conversation. UBS projects a 300 million ounce silver deficit in 2026. Pause on that number. Global annual mine production is roughly 800 million ounces. A 300 million ounce deficit represents nearly 40% of total annual mine supply. This would mark the sixth consecutive year of structural silver deficits, and the projected gap is roughly 2.5 times larger than the estimated 2025 shortfall. That is not stability. That is acceleration. 6 years in a row of structural deficit, an imbalance that is compounding, not correcting. Above-ground stockpiles have already been drawn down for multiple years. At some point, persistent deficits force price discovery, whether the paper market is ready or not. Now let's give gold its precise context. Gold has traded higher intraday before. Earlier this year, it touched 5,600. But a weekly close above 5,100 has never happened before. Weekly closes matter because they represent sustained positioning across global participants, not momentary volatility. Every fund, every institution, every macro desk had 5 full days to react. They closed at an all-time weekly high. In the same week, the Supreme Court struck down the administration's primary tariff tool. Silver flushed and reversed aggressively. Comex vault inventories continued draining. UBS projected an accelerating structural deficit. These are not isolated headlines. They are converging signals from the physical asset complex. Now let's present the honest resistance case. A stronger U.S. dollar can create mechanical headwinds for metals. If alternative tariff mechanisms deploy quickly and uncertainty resolves faster than expected, some institutional safe haven demand could rotate back into risk assets. Silver's sharp intraday recovery from 79.80 to 84 could invite short-term profit-taking before continuation. And UBS's 300 million ounce deficit is still a projection. Supply responses and demand shifts can alter real outcomes. Serious capital managers account for these variables. This is financial education, not investment advice. Every decision remains your responsibility. But here is the counterweight, grounded in data. The vault drain is reported, not projected. The UBS deficit forecast comes from a major global bank, not a retail newsletter. Gold's highest weekly close in history is a chart fact anyone can verify. Silver's buying response to negative Supreme Court news was immediate and aggressive. These are measurable realities. Heading into next week, the setup is clear. Comex registered silver down 12.4% in 30 days. Coverage ratio near 0.14. UBS projecting a 300 million ounce 2026 deficit, 6th consecutive year of structural shortfall. Gold printing the highest weekly close in recorded history. Silver absorbing macro shock and reversing sharply higher. The unresolved variable is how quickly alternative tariff mechanisms are deployed and through which legal pathway. Watch Section 232 National Security Authority carefully. That story is not finished. Markets do not move on headlines alone. They move on positioning, liquidity, and structural imbalance. Right now, the data suggests something deeper than a reaction. It suggests accumulation beneath volatility. Pull the Comex reports yourself. Verify the UBS projection independently. Open a chart and check the gold weekly close history. When you verify it, you realize this is not hype. It is publicly available data converging at the same time. And when multiple structural signals align while the crowd is distracted by headlines, that is when markets quietly reveal who is actually in control. Invest with logic, not emotion, not noise. OG out.